Imagine looking at two different companies. On paper, they both bring in the exact same profit every year. As a starting point, most people look at return on equity, or ROE. This calculation takes net income and divides it by shareholder equity to show how much profit a company generates using investor money. For both of these businesses, the math results in a 20% return. But those identical numbers are hiding a discrepancy. Two companies can report the same return on equity and still be completely different investments. One business might be running an efficient operation. The other may simply be accumulating debt. Trusting a high return rate without checking how it was built often leads investors toward a deceptive accounting illusion. This bar chart shows how each company pays for its operations. Company A uses shareholder money, a 100% equity base. Company B, however, secures half of its funding through debt. Because the ROE formula only divides profit by equity, borrowing money shrinks the denominator. Company B didn't sell more products or improve its margins. It used debt to reduce its equity base, which mathematically doubles its return metric. This is the leverage trap. It happens when financial engineering and debt accumulation are mistaken for actual business efficiency. The formula is blind to how a business funds itself. If you only look at shareholder returns, it is impossible to distinguish between a strong business model and a pile of aggressive loans. We have to look past the top-line accounting to examine how the entire capital structure is actually deployed. The formula for return on capital employed, or ROCE, takes earnings before interest and taxes and divides it by the total capital employed. By including debt alongside equity, it measures the efficiency of every dollar used. When we run our companies through this filter, Company A shows a 12.5% return, but Company B drops to 10%. The heavy borrowing made Company B look stronger on paper, but once debt is factored back in, the business is less efficient at turning capital into profit than its rival. Operational quality is only validated when the calculation accounts for the total cost of all deployed capital. Debt often feels harmless when interest rates are low and revenues are climbing, but if we assume an economic shift, where profits across the board fall by 30%, the situation changes. The heavily leveraged company is immediately in trouble. Debt creates strict, fixed obligations. Interest payments must be made even when conditions worsen, meaning a large portion of that shrinking profit is consumed by financing costs. We can measure this vulnerability using the interest coverage ratio. This diagram shows earnings divided by interest expense. For our debt-heavy company, that ratio drops to a thin 2-to-1 margin. A ratio of 2 leaves a business with no margin for error. A small revenue miss or a hike in borrowing costs creates immediate financial pressure. Leverage creates a deep asymmetry. During growth, returns improve gradually. During a crisis, damage accelerates quickly. These hidden operational realities eventually show up in the stock market through valuation multiples. In many scenarios, a highly leveraged company trades at a price-to-earnings ratio of 10, while a debt-free company trades at 22. To a beginner, the lower multiple looks like a bargain. Professional investors read that discount differently. They interpret the low price as the market accounting for the risk of a fragile balance sheet. Borrowing money is a tool, but it only creates value if the returns generated from that cash exceed the cost of the interest. Once that balance shifts, the debt becomes destructive. Seemingly cheap stocks often remain cheap because they reflect financial stress that isn't visible in the ROE alone, catching buyers in a value trap. A rising ROE is not a cause for celebration if it is fueled entirely by accumulating debt and weakening interest coverage. High-quality businesses are those that maintain a strong ROE and a high ROCE while carrying low debt simultaneously. Financial formulas cannot be analyzed in isolation. A 20% yield means something very different in an expensive money environment than it does when borrowing costs are zero. Authentic business quality relies on generating strong, independent profits, because when the economic cycle turns, leverage-driven performance rarely survives.